Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 19th, 2017. Wanted to do a video, relatively quick one on the broad markets, and talk a little bit about trends or lack thereof, and really speak to current trading conditions and what to expect. It's been frustrating lately because we are in a sideways trading range. That's what I'm going to talk about recently. I had made the case up until recently, that still holds true, that the trend since March 1st, we're looking here at the Willshire 5000 on this is a 4-hour period chart, meaning each candle is just 4 hours instead of an hour or a daily candle. I just wanted to cover this span of time. That's why I chose a 4-hour chart. So here's March 1st. I'll put a vertical line up on there if I can hit it. It's a 2-day candle. There it is, March 1st. And so you can see the trend is down. However, it's also sideways. My expectation, I didn't foresee that the market would be in a sideways range for this long, and it is frustrating. In fact, there's comments in the trading room. I know some traders are bearish, some are bullish, and I respect that. I respect all views, and I see frustration mainly from those bearish and short, that the market, particularly the Qs, won't go down. And it's funny because in my mind's eye, I can see a caricature, one of those little cartoons you'd see in the financial media, with a bull and a bear sitting at the table, and you have those little thought bubbles through their head, and the bear saying, darn it, this market just refuses to go down. And then on the other side of the table, you have the bull saying, darn it, this market refuses to go up. Because in reality, the market has been going down since March 1st. We're well below the March 1st highs. The only index that didn't peak, as I mentioned many times, on March 1st was QQQ. The QQQ isn't really a representative index. It's only 100 or so stocks, mostly technology stocks. So as I put up before, you put up a chart of XLK, which is a technology ETF, and it will mirror QQQ almost perfectly. So QQQ is just basically a tech fund with Amazon and a couple other consumer discretionary top-heavy. Amazon's top-heavy. That's why there are other industries in there, but again, it lacks a lot of other industries such as financials and things that the diversified indices use. So this is a Willshire 5000. If I had to pick just one index to be the most representative of what's going on in the stock market, it would be the Willshire 5000. The S&P 500 is great. There are 500 companies, but they're all large cap stocks. You don't have any mid or small cap. So again, this is a way to look at the market, what it's doing. And so today, just real quick, we'll talk about trends, how to trade them, and recognize a market for what it is. That's most important. And, in hindsight, am I telling you we're in a sideways trading range? Yes. I didn't expect, again, I thought we would break down and be moving sharply lower by now. That hasn't been the case, nor have we gone any higher. Again, you can see here the trend has been down. And now let's just talk about trends real quickly. So this goes back a little over a year here, because you can see March of 2016 to the left of the chart. And as you can see, the market has just a pretty clear pattern, and this is what you need to recognize what type of market environment you're in, and then adjust your trading accordingly. If you're becoming frustrated right now, whether you're a long side or short side trader or both, like myself, I'm a flexible trader. I trade long and short at almost any given point in time, especially if the trend isn't clearly bullish or bearish. Then I'll hedge up, take the best looking longs and the best looking shorts. But you can see here's the market. Let me just make that arrow a little bit bigger. A clear pattern of rips or uptrends, I should say, and you can see them defined by the uptrend line below, well-defined uptrend line. So a clear pattern of uptrends and then downtrends. Here's a downtrend. You can see the downtrend line above. Here's an uptrend. So this is a trending market. This is where swing traders make money. If you're long or short, these rips or dips, and that's what swing trading is all about. To define it, swing trading is, at least by my definition, an average holding period, typically measured in weeks. Some swing trades only last a few days, occasionally even one day if they're an explosive breakout and the price, the stock jumps up 10, 20, 30% in a day. You might hit your target, but on average, I'd say 4 to 6 weeks, 3 to 6 weeks, somewhere in there. Some trades last months. It all depends. Now, is you can see there are periods of, as these boxes indicate, sideways trading ranges. And, you know, you occasionally have a false break above or below the trading range as we did here. You can see that little false breakout. But for the most part, the market traded sideways in this range right up really to about this point. That's where that box should end. However, I left it there because what you can see is there was a multi-month trading range. We broke below it and then came and did a virtual back test of it. In fact, we actually hit, you can see a pretty well-defined downtrend line above there. And that's what we hit perfectly, and then boom, a correction. So what I've done on this chart, clear these out, is just highlighted the, well, I'll get to these in a second, the drops here. But what I want to do, again, impress are these trends, and this is what you want to catch as a swing trader. Unfortunately, from time to time you get caught up in these sideways trading ranges, and you know, barring some, you know, very adept security selection, you know, buying breakouts, you know, trading, you know, the best looking setups, you can make money in those ranges, although it's much more difficult. You guys all know the old saying, the trend is your friend. So, you know, if you're positioning, you know, long towards one of the end of these breakouts after a big rip, you're going to make money. And if you're positioning short, you're going to make money. And again, you can make money on any of these trends. You can make money in here day trading, but you might want to adapt your trading style. Or, and for, I know this probably speaks to the majority of the people that are, you know, following right side of the chart or members. If you're not full-time traders doing this, you know, all day in front of a desk, you work a job or trading is a part-time hobby or passion for you, then, you know, recognize the market for what it is and step aside. Be more selective on your entries. Don't overtrade. If you overtrade in a trading range, you'll lose money. And again, had I recognized, it's almost impossible to recognize when a trading range will occur ahead of time, but it is, I think, important to realize, you know, recognize it for what it is once you're in it. And that's where we are. As you can see here, again, the boxes illustrate. So we've been trading pretty much sideways since going back to, what is that, February? If I put a crosshairs here, the horizontal line, you can see today prices are exactly where they were back on February 15th on the Willshire. So we've gone absolutely nowhere. Bulls had a little victory, bears had a little victory, about equal, you know, and move from February 15th, but we're right back to where we were. So that's that. Now, okay, all well and done. We can recognize in hindsight trends. What good is that? You know, one thing that I can't stand is hindsight analysis. So there is some value in this, and this is the magic of indicators and oscillators, price and momentum indicators. So we have here, for example, the MACD and RSI, and down here a trend indicator I like to use on various time frames, 1333 EMA pair, and I just put it here in a histogram form that shows when the 13 is above the 33 EMA, then the histogram is green. When it crosses below, it's red. And you know, the differential between the two is indicated by how far these the histogram is. So in other words, when you have the histogram very high like this, they're trading far apart, those moving averages. And as it comes down to the zero line, that means the 13 is about to cross the 33. All right, so where can we take any value or try to extrapolate, you know, where the market might be heading? In other words, yeah, it's great to know we're in a trading range, but you know, until it makes a definitive break, or if you want to position ahead of time for that break, it would really be helpful to know which way it was most likely going to break instead of just a coin toss 50-50. Well, it's either going to go up or down. We know that. And again, this is where the divergences come in. So you can see that I've drawn out divergences here. In this case, negative divergences. And I've marked a divergent high, DH. I don't have the divergence line, but you guys can figure it. When prices are making higher highs, as they were here, from this period of time, we had higher highs. We had a little blip, but we went on to make another high. With all the indicators making lower highs, that is negative divergence. That's what the DH stands for. And I put the corrections down there. So you can see we had a divergent high at this point, followed by a 6.5% drop. Not bad, especially in a primary uptrend. You gain a 6.5% drop in the broad market, and I can all but assure you the individual short trades that I have will probably come close to doubling those returns, if not more, because this is the broad market. This has everything in it. It has defensive issues, high dividend paying stocks. So if you can, via proper security selection, find the most bearish setups, at least I can tell you this, almost 9 times out of 10, if not 10 out of 10, I can outperform the market by avoiding the most bullish stocks and only shorting the most bearish. And ditto, vice versa, I should say, on a rip, going long the most bullish stocks, avoiding the most bearish. So my preference, as I often say, I will take market shorts from time to time, but for the most part, the vast majority of my trades are individual stocks and or sectors via ETFs. You can do just as well, trading the most bullish or bearish looking setups at any point in time versus trying to trade the broad market. The financials are a good example. I just did a video on that last night. We're short the financial stocks, and they've had a nice swoon down recently while the broad market's gone virtually nowhere. So there's one example of security selection where you're sniffing out a sector that was clearly bearish, clearly set up for a fall, and has done so and profited. So here's your next divergent high, you can see here, and that was a 5.2% drop. Fast forward, and again, going back for the last year, we've only had 3 negative divergent highs, with clear negative divergence. The most recent is this divergent high here. So far, and that's why I have a question mark, we've only dropped 3.6%. And just to draw out the divergence, there it is. There's the divergence line, just as I should have drawn here for you. So we've had a drop of 3.6% at this point. I put a question mark because that is on the low end, especially with what you'd expect with, this is the largest divergence that we've had over the last year. I should say it probably comes about roughly in line with this one. This was a pretty large, this was double divergence. You had a divergent high here, followed by another consecutive divergent high. So maybe the correction's over. Maybe that's all it's going to take, and maybe not. That's why the question mark's there. And most importantly, when we zoom in, we look at the trend. And the trend, here's the downtrend line above. You can see, the plain and simple definition of a trend is a stock or any security or index making a series of lower highs. So we had a high here. We had a couple about equal reaction highs there. Reaction high there. And until and unless that reaction high is taken out, and particularly a breakout above the top of the trading range, which will also take out that previous reaction high, the trend remains down, although it's still somewhat in question. I refer to this as a sideways to down range. Let me just circle here the reaction lows. I mentioned, a downtrend by definition is a prices making a series of lower highs and lower lows. So far we had this reaction low off that high. We had a reaction low right here at the bottom of the trading range. It was just below that one there. And we haven't yet undercut that low. So the trend, again, it's certainly more bearish than bullish. Just, taking a quick visual, you can see the downtrend right there. But it's also sideways, as I mentioned, going back a couple months, we're just where we were, and on that most recent move down, we never undercut those lows. So it's somewhat in question. It's not completely called into question yet. What would really call the current downtrend into question? Well, most certainly a break of this downtrend line would start to do so, especially if that breakout took out these previous reaction highs. The next bullish event would be a breakout above the top of the range, which would also take out these previous reaction highs. Okay, so that's the bullish case. And if we do break down below here and we take out the previous lows, well, that just reaffirms that the downtrend is now, goes back to March 1st when we peaked, that the downtrend is still very much alive. And we could see something similar to what we saw back here, where we had, one little whipsaw breakthrough there, just like we did back here. We snapped back in the trading range and we broke down below, we back tested it, and then we had a pretty sharp sell-off there. So that's one possibility. Now, for those bullish, and I'm trying to keep my options open right now. I do recognize what I call potential divergence. We don't have it yet. If you look at the MACD down here, the RSI, and the histogram, there is potential positive divergence. Now, potential because we have to make a lower low in price to do so. So a scenario of something along these lines. If we reversed here soon, undercut these lows, you'd need to do that to have, or at least make an equal low. We can have an equal low, match these previous lows, and then reverse. And if we do so without the MACD, the RSI, the histogram, and any other momentum or price indicators that you use, we would then have positive divergence in place. And that might set the stage for a rally and an upside break of the downtrend line and especially the trading range. But just be aware that these trading ranges are prone to whipsaw signals. It's not uncommon. In fact, it's more than common to see that. So I guess the takeaway from this video is don't become frustrated. Don't force your trades. The trades that I have on, I'll leave on with their stops that were set strategically based on the entry price, based on technical levels. The vast majority, if not all of the short trades on the site are still profitable right now. Longs have been, doing some hit or miss lately. I think I have to check, some profitable, but it's been tough. And that is a signature of a trading range is that you'll see an increased rate of failed breakouts, whether they're bullish or bearish setups. It's just the nature of the beast. When you're in a sideways trading range, you're going to have more whipsaw signals than once we start trending again. So that's it. Until we have a definitive break of this trading range. And right now, as I said, the takeaway that I have from this is these were pretty powerful divergent highs. So far, only a 3.6% drop. And in my opinion, that's about half of what we had back here. Almost half of what we had back here. So there's a good chance we have at least another thrust lower. And, until we get the downside break and confirmation. And remember, that downside break may put in bullish divergence. This bullish divergence may be taken out. So we'll just have to take that as it comes and see how the charts develop. Couple minutes ago, I'll just wrap up with some of the indexes that you guys are trading, or at least that I'm trading now. Small caps, I know the small caps garner a lot of interest, and they've been more volatile than anything. At day-to-day swings, if you can game these little, mini bounces within the range. Let me just step back and tell you what I'm referring to. This is a bigger picture. I just jumped to a 2-hour period chart. If I don't mention, it's right up here on the left-hand side. So this chart goes back to, looks like September or so. Now, the story on IWM is we haven't seen anything like this in a long time. This is a massive, very tight, fairly well-defined. We only had this one little false breakout here, failed bull trap. Otherwise, we have been slogging around sideways going all the way back to November in IWM. So, be thine bull or bear, you cannot declare victory if you're trading the small caps, unless you're going long at the top of the range, short at the bottom. Other than that, it's been a frustrating trade. I've had shorts on IWM for a while. All of them, a couple positions scaled in towards the top of the range. Still profitable now, but it's frustrating. I'll have to be honest with you to see, some decent gains one day, the next day give those gains back. But, until we have a definitive break, it is what it is. And I can tell you this, these trading ranges don't go on forever. Typically, not always, but typically the longer you trade in such a tight sideways range, you have the Bollinger Band starting to pinch, contract, volatility's low. Typically, the move out of such a long, extended, tight range is pretty explosive. So, don't become complacent. be ready, be on guard, you know, have your ducks in a row, whether you're bullish, bearish, or you're flexible and you're willing to trade this thing whichever way it breaks. Have your setups in place. You know, I'm going to continue to post trade ideas because that's what I do. That's what the site's all about. Whether I take those trade ideas, whether I'm bullish, whether I'm bearish, my job is to put out the best looking setups, whether they're longs or shorts. And then, you know, your job is to, if you like it, trade it. If you don't, pass on it. And that's what we're looking at here now. There's a downtrend line right there. Let me see. Let me go back to the 60-minute chart. This is a minor downtrend line. I don't give it a lot of validity yet because we only have 2 reactions so far. We've just peaked above it. If we reverse here and this 60-minute candle closes down below there, that would be considered a reaction. Then we have 3 reactions. In my book, at least, it takes 3 reactions. 1, these are tight in a cluster, so I consider that 1 reaction. 2, 3, at minimum, to validate a trend line, because any 2 points could be connected at random. So there's a potential trend line. You can see the other trend lines here. You know, you short a break of an uptrend line. You had a divergent low here. You go long. Another divergent low with a bullish falling wedge, you go long. So there's a downtrend line, and you know, if we break above that, that could take us up to any of these other support levels. But again, the bigger pictures, we're smack dab in the middle of the trading range, so you're likely to get chopped to bits, and the odds of a false breakout, if we do take out that line, are increased. I have to say that. And there's another downtrend line back there. You can see off the highs. And that was an example of a false breakout. We broke out and it failed. So again, it's choppy. If you're quick and nimble, you're probably not even listening to this video if you're that experienced in trading and you can do well inside these trading range. This is really the realm of a day trader, to be honest with you. You know, someone that can live within the 5-minute charts, 10-minute charts, the real short-term charts, try to recognize these short-term patterns and trade, make a day trade and get out at the end of the day, because price action's been whippy. So that's IWM. There's a level to watch. Let's see if we reverse there. I'm leaning towards that scenario, but we'll see what happens. The SPY 2-hour, let's go back to a 2-hour chart. This was a trend line that was really doing a great job at defining an uptrend in the SPY. We've sliced through it recently, and that when that happens, that trend line loses validity or importance in my book, because we've started to slice through it a lot. However, we are trading below it. We had a little whipsaw breakdown there, snap back above it, we danced on it, and then we've broken down. So overall, that's more bearish than bullish, that we're trading below that trend line that goes all the way back to looks like late November. And you know, as highlighted here, we had a series of divergent highs with one large, if you look at the yellow lines here, one large powerful divergent high here. So in my opinion, that hasn't played out for the full amount yet, and I still think we're going lower. You can see some of the resistance levels overhead, the horizontal lines on my chart, if above their resistance, if below their support. And then we have the almighty Qs. As I talked about, Qs have been strong, but the story isn't much different. Let me go back to a 60-minute chart here, zoom in a little bit. As far as trading ranges, so you know, there's those that say, oh, the Qs refuse to roll over. Well, again, going back to that caricature in my head, you know, if you've been bullish and long the Qs, you haven't gone anywhere since since February or so, early March, yeah, beginning of March, late February. That's where we were right here, and that's about where we are there. If you notice, and what I did is I shaded the sideways trading range. It goes back to mid-February. Notice the line, the resistance level that I have in the middle. It really does a good job at defining. It contains prices when they're below, and then when above, it also acts as support. And you break down, come up, we moved above it, we found support there, we found support there, broke down below, it was resistance, now we're above it. So that's a little bit of a heads up. As long as we remain above it, that's near-term bullish, but again, we're still well off the highs. And as I said, the Qs are not as representative as the rest of the market. And you know, when you start to see the downtrend in S&P, in the S&P 500, the mid caps, the small caps, the Willshire, if those trends are called into jeopardy by the criteria I mentioned earlier, the downtrend lines taking out the previous reaction highs, then I might be looking, change my current views, which is that the fact that this trading range is most likely going to resolve to the downside. Like I said, it's been frustrating, but here's the targets, and I think they still have a very good chance of being hit. We're just going to need to finally break this trading range, and once we do, there's a bottom around 129.75 or so. These are the levels that I expect reactions. You can see this purple uptrend line here. That comes in right around my first target here on Qs, 126.10, and that we'd have to break down right away and have a meltdown within the next week or so. Keep in mind, Friday is options expiration. I often talk about the OPEX ramp, and that is the tendency for the market makers or the powers that be to hold the market up into options expiration, to let all the puts roast, let those puts expire worthless, and then you typically see a drop right after, within a few days, sometimes the Monday following options expiration, but usually by the end of that week. So it wouldn't surprise me to see them hold this market up for a few more days here. Today's Wednesday, got a couple more days to go, and then let things go next week. And if that's the case, then that downtrend line could still come in right around the first target level, and that's my minimum downside target. And we'll see what happens there. My expectation would be for a reaction, and who knows, maybe that's the end of the correction, but wouldn't surprise me to see that level go and any of these additional targets be hit. All right, let's wrap it up here, and if I see anything that stands out, I'll post it. Other than that, like I said, just be on guard and be ready for whatever the market, whatever comes your way. And by being ready, it means just have your setups, your favorite trade setups. If you're currently in the market, have stops that are in line with your risk tolerance, depending on your entry price. Sometimes when in a trading range, I might extend my stops a little bit because of that noise, that back and forth grind. But if the charts start to firm up on the bullish side, then I'm going to let my positions go. I'm not going to give them any extra room. But as of now, I'm just sitting tight. And again, I'm trading selectively. I'm trading individual stocks, and I'm only shorting the sectors that look the most bearish at this point in time. Ditto on the longs. Anything that stands out on the long side, whether it's a sector or an individual stock, I have no problem taking that. If the markets do break to the downside and we start to, as time goes on, we build up evidence that the trend, especially the intermediate term trend, has shifted to bearish. Right now, we only have the short term trend, bearish to sideways, we'll call it. And, we'll just have to, assess the markets as they go. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.